I hope you're having a wonderful day wherever you are. I'm your host, Jesse, with another episode of Bullish Banter. I'm joined with two special guests, and I believe you would want to sit down and listen to this conversation. First of all,
hi guys, Rufas here, markets analyst at FX Pesa. Hopefully, we are going to share some good content surrounding personal finance as well as investing in both Kenya as well as offshore.
Yeah, and without further ado, we have a special guest, like I mentioned, Kahome.
Hello, guys. So my name is Gichuki Kahome. Maybe most of you know me from Twitter.
Yeah.
So I'm the CEO and founder of a company called Coin Connect Kenya.
Yeah.
So we just help people manage their money and invest their money so that they can make the most out of it.
Okay.
Yeah, so basically in simple terms, that's what I do.
Maybe a quick one, What is your opinion of the Kenyan capital markets?
My opinion of the Kenyan capital markets. Okay, one thing I'd like to say is if I can start with maybe the Kenyan stock market or the Nairobi Securities Exchange.
Yeah.
We know that basically the stock exchange is a reflection of how the economy is performing.
Yeah.
And also, it's also good to know, okay, we complain a lot that our NSE is not doing that well. But
I mean, it is not
doing
for
well.
a couple of years.
That's a fact.
I think we are bottom 12 globally.
Sad, huh? You are saying something?
I think if you look at the space, the African space of African stock exchanges, you'll notice that we have countries that don't have active stock markets.
Yes.
The last time I checked the report that was stable, I think around 2021, we had around 14, 15 African countries without active stock markets.
Okay.
That means no public companies that are listing or trading of shares takes place. So coming from that, or looking at the perspective that Kenya is a developing country, or the traditional phrasing of developing countries in the developed world, I think we are not doing, okay, we can't say we are doing well, but considering that other 14 African countries don't have stock exchanges that are active, we cannot complain that much.
Are you bullish on the Kenyan capital markets or the big bear falling off 50 floors? Or should I say 60 floors, given that we just celebrated our 60th anniversary?
Okay, I think for myself, the big issue about our Kenyan stock market is the fact that it's dominated by foreigners.
Okay.
If you look at when our stock market has peaked from its all-time highs around maybe 2016, 2017, it's when the number of foreigners active in the stock market were highest to I think it was around more than 60%. But now with the cycles that come with the Kenyan stock market, the elections and some other internal factors like the government that is in power or the coalition that is in power, and the bills or the laws that they are implementing, we have seen our foreign investors fleeing at a very high rate. I think right now we are about 40% foreign investors.
Okay.
So I think if we as Kenyans can, I think most Kenyans prefer investing in land, real estate.
Okay.
But I think if most Kenyans can be cognizant of the stock exchange market in Kenya and we take, we increase the what do you call it? Participation of the Kenyan local investors in the stock market.
Yeah.
We can dictate the pace and, our capital markets can be doing much better.
Yeah. I know for myself, I'm optimistic on the Kenyan stock market, but every day that optimism gets negation on a very gradual steep. Like I said,
he's taking the orange pill. So I keep telling him, if you have to eat a toad, then you have to go for the juiciest one. So when we literally talk about investing in stocks, you're basically buying a proportion of a business. So every time the CEO, the employees wake up very early on Monday to go and work, they're actually working for you.
Okay.
So if you want to put your money in a place where you want some good growth, why not just go for the best companies in the world?
Okay.
Yeah.
Now, capital markets is not just, of course, NSC, right?
Yes.
I know you have been talking about bonds market, treasury bills market. Perhaps, I think until 2 or 3 issues ago, we are having oversubscription. And what I've come to notice is on my observation, I've not been particularly tracking the bond sector. Infrastructure bonds tend to have good subscription rates. But if it is just the normal recurrent, like the T-bill, 91 days, 30 days, I think 365 days, they are having very low subscription rate. Perhaps this is just to finance the recurrent expenditure. Is it because perhaps, because I know that is where now local investors, the Kenyans themselves, do participate in. Is it because there is very little or dwindling trust in the government to repay the debts? And I know there is an article you have written that it is almost guaranteed that you'll get payments from the bond. Is the optimism, or rather the view of the bonds market reducing in terms of traction?
Okay, for me, what I'll say is, if you look at the conditions that we are in right now, whereby we are looking at how the Kenyan government can be able to repay its debt. We have maturing Eurobonds that are coming in. A big part of our budget is going to repaying that bonds. Debt. So from a perspective of buying bonds and bills, I think undersubscription comes in this way. The risk now has increased investing in bonds and bills because of where we are right now, our economic condition right now. So investors are bidding in at high rates. So they know the government doesn't have money to finance its budget. There was a budget deficit. So they know the current situation the treasury is in. So they are pushing the government for higher rates. And they want to be promised higher rates because they are taking advantage of the current economic situation.
Interesting.
Then also the issue you mentioned about bills and bonds being undersubscribed sometimes. It's also an issue of a few months back we had bills being oversubscribed and bonds being undersubscribed. That's because most financial institutions were really asking the government for higher returns because of the increased risk that they were entering into. But now I think the past few weeks we have seen short-term securities being undersubscribed and the bonds going back to being oversubscribed. So it's just a matter of how the markets play and also the factors that are influencing the market. But I can say right now, because of the risk that has increased, because we're not sure whether the government is going to repay or it's going to come out of the current economic situation. That's why investors are pushing for very high rates. Actually, when there was a discussion the other day that people are pushing for a return rate of 15% from the floated infrastructure bond.
I saw that.
Because they're aggressive, because they know the current situation the government is in, because they want money, and from the foreign markets, from already we are behind in tax collection, in tax revenue collection. So the government is in their need of money. So investors are taking advantage of that.
I think even in the prospectus for the latest infrastructure bond, there was no what you're getting, the interest rate or something, even the coupon rate. Nothing was indicated on the return. It was just, we are doing this, give us this is what we want, minimum, whatever, done. You have no idea how is it 9%, is it 14%? And
I think now that Gichuki has mentioned about risk, there's something we are not really considering here. So most people are really thinking, if I put my money here, let's say in stocks, these are the average return, and upon doing a comparison analysis, they find that the bonds are the ones that are giving the highest yield. But nobody is really asking, where is this yield coming from? So yes, the government will pay you, let's say 1 year down the line, you get your 13, 14%, but where is it coming from? So the government is not making money. So it's the people who are actually making money, and the government taxing that money. So if the government keeps on raising the yield, then the yield has to come from somewhere. Either on one hand, you are seeing increased inflation, currently 7.9%. So even if you're getting let's say the 14%, already 7.9% is going down from the value of your cash. On the other hand, there is also higher taxation. So in order for the government to afford to keep paying the interest of these loans, then it has to keep taxing you higher, the same person who is investing in these bonds. So it's more or less like taking from one pocket and putting to the other pocket.
I think by the time this episode will be going out, we'll be reaching the tail end of the finance bill discussions in Parliament. Now, in terms of risks, with the intended, perhaps, if you aggregate all the basically increment on what you are liable to pay the government, does it pose a risk to especially local investors? Because definitely it will affect your expendable income. And connect that with now, what is the simplest way with what you do at Coin Connect and obviously approaches to investing and savings? How do you combine all those risk factors that Rufas has mentioned, plus the new one, which is coming, the finance bill, and deciding which investment avenue to take going forward?
Okay, for me, maybe I'll start with the point Rufas was mentioning about where the risk is coming from.
Yeah.
Also connect with the point that you really attacked me with, saying that I say that bonds are almost guaranteed returns. Yeah. Okay. Yeah. Why I say almost guaranteed returns is because the government of Kenya has no history of loan default or of defaulting. Mm-hmm. Yeah, so that's why we say almost guaranteed. Okay, obviously the past does not predict the future.
Definitely,
but it gives us a clue of what may happen. So I think that's one thing. Then the other thing about the finance bill and the taxes, I just think the poor and the middle class are the ones who will get affected more by these taxes, because even if you try to tax the rich, it becomes very hard because they have many income streams. They have assets that are really hard to tax.
Also, it's a small pool.
Yeah, it's a small pool. Okay, not necessarily. Okay, it's a small pool, yes, but I don't think that adds them to being hard to tax. Maybe it does, but also it's just the dynamics of the kind of assets that they own that makes it really hard to tax.
Okay.
Yeah, so I think the poor and the middle class or the low income earners will be affected more because now they'll have less income to do with, less savings. So less money will be put into savings and investing.
Yeah, it's true. I think I agree with that part. Where you see the higher income individuals, they tend to own more infrastructure, and of course the hard assets, things like housing, real estate. Yeah. So if you hike taxes on them, then they basically transfer the burden to the lower income earners who don't own those assets.
So in terms of rent increment,
yes, they just spike it up and make sure that they are the same level or even higher. So in history, whenever you go after the big guys and tax them more, they basically just transfer that load to the lower income earners, and the problem just gets bigger.
And Laffer curves comes into action.
Yes.
Perhaps you are a young person, newly employed, good deal has come about, you are getting $1,000 or $100K gross in salary. What do you normally recommend to such guys or ladies, especially when they are trying to begin their financial planning and obviously their investment and savings journey as well? What are some of the factors and how do you sort of mentor them through the journey?
Okay, for me, it comes to a couple of factors. So one is the saying that, or the belief that, or getting the right mindset that investing is a journey, is a lifestyle. So it's not a one day blue pill or one day thing that you do and say, I've made it, I'm now wealthy, I'm now financially free. So it's one step every day. It's a journey, it's a lifestyle that you have to adopt. So you have to, whether it's your savings, whether you want to, your savings rate, having a high savings rate constantly or regularly throughout the year, then constantly buying income generating assets.
Okay.
The best advice I think I've ever come across, how to grow wealth or how to build wealth, it's by a guy who has written a book called Just Keep Buying. And the advice is just those 3 words, just keep buying. Okay. So each and every time, each and every month, whenever you are paid, you have money that you put aside to buy income generating assets. So there's some stocks, whether it's some ETFs, whether it's putting some money aside in a money market fund.
Okay.
Just building that savings culture and letting compounding do the work for you. So I think that's one thing. Then secondly, it's increasing your income, because one thing that we all have to agree on is it's income that builds wealth.
Yeah.
Because it's how much you save, and then you buy these assets that determines how you grow financially.
Yeah.
Because there usually two comes when it comes to personal finance. One thing that you can get rich by, or you can get wealthy by cutting down on expenses. The other one says you have to first increase your income.
Yeah.
So it becomes a little bit of a challenge when you are looking at what you can optimize on, because cutting down on expenses has a limit, because you still need to survive. You cannot reduce your expenses to zero.
Yeah.
But now when it comes to increasing your income, it can go to infinity. You can increase your income to a very big level. Yeah. So that's one thing. Always look for ways that you can increase your income.
Okay.
Extra income sources, whether it's passive income sources, whether it's active income sources.
Yeah.
That will always go a long way with you. The other thing is how you approach investing, depending on your age and also your financial goals.
Okay.
So like for young people just getting started with their careers, It's more about your savings and how you go about the big financial goals in life. That's choosing your housing plan, whether you're going to buy, build, or rent. The one is choosing how you're going to buy your first car, also how you're going to finance your first house, whether it's a mortgage, whether they're not financing the whether it's a loan, whether you're going to buy it cash, depending on your income. Also, there's also some key financial decisions. Also, how you start investing. You know, I think our Kenyan idea of investing is that most people tend to incline towards land and real estate. So you'll find a guy who has just started his career, 3 months in, 5 months in, he's looking for a 100 by 100 plot, maybe in Kamulu, Juja, another place. But if you look at the state of land, okay, I'm not against land and real estate. But it mainly depends with where you are in your financial career, or where you are financially, and also your financial goals. But I think for a young person, you'll get, because you can take more risk. Also, you are trying to build wealth, not to preserve wealth. Because, you know, a billionaire who is in his 60s or a millionaire who is in his 60s, the goal is to preserve wealth because you're approaching retirement. But now for a person in their late 20s or early 30s, your goal is to build wealth. So you can take more risk, and you can get that exposure or that ability or that exposure to that opportunity to build wealth through the stock market. More so foreign stocks.
Now, just before we go foreign, land and obviously real estate. Do you think the market is saturated in Kenya? Is it how do I put it in a more subtle manner? Is it overvalued, or is it a bubble about to burst? Because anywhere you look in this Nairobi, there is some crane pulling up tons and tons of cement and concrete and everything. And I'm not sure of the occupancy rates of a lot of office spaces and obviously residentials. But of course, there is also other investment avenues whereby you are able to purchase houses off plans, so that you're able to, you know, achieve perhaps ownership in like 10, 15 years. And like you mentioned, I like that saying that in your early 20s, late 20s, early 30s, you are looking to build wealth, to create wealth. So real estate, is it overvalued, a bubble about to burst, or it is something that people should approach at least as an alternative after you have a way in which you are getting some passive income?
Okay, first, if we look at the factors that drive real estate, if you look at Kenya and our economy, or as a population, how we are right now, the demand for real estate and for housing is increasing because most of the population is moving from the rural areas to the urban areas. So that's why you see these big houses, these big rentals, these big apartments being constructed every day. So there's a huge demand for housing. And for offices in the urban areas, because we are a developing country. And you know, just the factors or the characteristics of a developing country is that people are moving from the rural areas to the urban areas. So there's a big demand for real estate. But now, how it plays out, it's the big question, how it plays out. You know, you're also, you're not trying to time the market, but also how you're positioning. Maybe when you are trying to buy a piece of land or a piece of property, for most people it's a long-term game, because you're anticipating that within 10, 20 years, the urban population is going to grow. And if the urban population is going to grow, you anticipate the demand for housing or for real estate or for rentals is going to increase.
A quick one. Would you advise Jesse to get a loan and grab maybe an acre in Gichuki?
Very good question. I've been thinking about Nanyuki. In fact, when I was there's a time I took a trip down to Amboseli, and I was like, if I get 1 million, okay, not 1 million, that's understating it. A couple of them, a good ranch there.
It depends with their goals of the piece of land, and also your financial position.
What if I just want to acquire, because I believe in some time they will want to build an airport, or an airstrip, or even better yet, give a return back way for SGR, some white elephant project
come
again.
Back to reality. Get off monopoly money.
I think that that is the basics of it, right? Like there is this belief which has existed over a long period of time, and I believe it has been proven or even reported that some pieces of land do not necessarily appreciate in value. Some actually depreciate in value, right? So, you know, those are some of the things which I think in the current generation, and obviously there are some regulations which are in place to avoid or limit how much a piece of land can, I believe, appreciate in value. Yeah.
Personally, I've always had this stand where it's way better to invest in yourself and what you do.
Yeah.
So if you are, let's say, a guy who is really good in Forex, maybe you are best suited investing in what you know in Forex.
Yeah.
If let's say you are a content creator, maybe get some new merchandise to help you expand your content creation, or even build it into a business, rather than just putting some idle money in a Gichuki where you probably don't plan to develop in the next 5 years,
or even don't know the socio-economic situation.
Literally expand your current income, and then whenever that business matures and you have good cash flows, then you might consider now going for that piece of land in a Gichuki or whatever that is. So I think investing in yourself, your skill, or your expertise has more fruits compared to just speculating on land.
It's a good segue to international markets now. I mean, in Kenya, we have seen NSE that we started with is basically dwindling in terms of value and obviously returns to investors. I believe the most one can get is in terms of dividends, right? Now, in investing overseas, offshores, be it Australia, be it China or Southern Asia, be it Eurozone, what are some of the factors yourself perhaps consider before saying, okay, I want to buy 10 shares of Boeing. I want to buy maybe 5 shares of Puma from Frankfurt. I want to buy maybe, HSBC from Hong Kong. What are some of the things that you look at?
Okay, maybe before I take that, maybe I can elaborate something that Rufas was saying about investing in yourself. So I have this article that I think it's one of the most read articles on my blog that it's a topic on investing for young people. And now investing in yourself. So if you look at the returns that you can get from the market, basically per annum, it's the average it's around 12%, 13%. That's the best that you can get per annum. But if you look at investing in yourself, the returns that you can get from that, maybe you are in a low-paying job, maybe you upskill, you get to a high income, you get a high income skill. Maybe you're a business person, you get more capital for your business, or you expand to a few more areas. I think you can get way more returns from such experiences, or from investing in yourself, or from investing in what you do, than putting your money into stocks, real estate, bonds, or these other customary assets. So I agree with Rufas that investing in yourself, investing in what you do, it's the easiest and the best way to grow wealth. So I just wanted to touch on that because that was important.
So a quick one. What's your blog? So our listeners can actually find the blog and read the articles.
Okay, the blog is just mynames.com, so gichukikahome.com.
Awesome.
Okay, so your question again was, what are the factors that I'm looking at when I'm investing in offshore stocks or foreign stocks? Okay, so nowadays, with the foreign markets which are a little bit more developed than our Kenyan markets, we have ETFs, or what we call index funds, whatever you want to call them. So I think they give you better access to the markets, because it also spreads the risks. It's also a little bit more diversified. Because now if you have your high income at the end of every month, then you are putting a certain percentage of your savings into let's say, an index like the S&P 500, which tracks the performance of the top 500 companies. You have the workers from the top 500 companies globally working for you, just here in Kenya. So I think for me, approaching investing more so in foreign stocks with the perspective of index funds or ETFs, it's better than going for individual stocks. It depends with your risk profile and with your financial goals, but in the long term, 5-10 years, even there's a report published by a body called, I think, HIVAC, which is an international body. It actually compares the returns from local and institutional investors or fund managers who invest in individual stocks versus the returns from the benchmarks, the bench indices like the S&P 500, like the Nasdaq 100, or just any indices that mirrors the performance or the types of investments that these fund managers are investing in. And the reports are unbelievable, because you'll see that if you take, for example, 1 year, you'll find that 90% of individual investors of these fund managers don't beat the returns of these index funds or these ETFs. But now when you go to the long term, 5-10 years, that percentage increases to more than 90%. So yes, you can try to beat the market, it's possible, but it takes a little bit more.
I think there are probably 2 or 3 fund managers are like the level of Howard Marks. who have been able to beat the market for a substantial amount of time. And the one who was the deputy or the shotgun for George Soros back in the 92. I'm forgetting the name of the fund. He ran a streak of almost 30 years, always beating the S&P 500 and the Nasdaq. So probably just a handful of people who
the number is bigger.
For those who have been beating for an extensive period of time.
Yes.
Perhaps we can track that and we can be able to share with
you should
our
track
listeners.
Peter Thiel's portfolio. It's really good.
Okay.
Yeah.
Interesting.
Also, I think there's a benefit, especially when you consider yourself as a Kenyan.
Yeah.
Where if you're investing in offshore stocks, you also get to gain from the forex gains.
Okay.
So considering the trend that you've been observing over the years, that is the Kenyan shilling versus the US dollar, as well as the pound and the euro, you realize that if you invest outside, you're not exposed to the inflation happening here.
Yeah.
So the depreciation of the shillings works towards your benefit. So for instance, a person who, let's say, invested in NVIDIA at the beginning of the year, in dollar terms, they will be up, let's say, 170%.
Yeah.
But then when you add the losses in the Kenya shilling, then when you convert back your gains to Kenya shillings, it literally just breaks above 200%.
Yeah.
So there's also that benefit where your funds will not be exposed to the inflation that we are currently experiencing here.
Yeah.
So in contrast, a person who put their money, let's say on a bond, at the beginning of the year or a stock in Kenya, when they get back their money in Kenya shillings, that money would have devalued as a result of the current inflation we're experiencing here. So there's that forex benefit that people tend to overlook over time.
Yeah. Maybe as we come to some sort of a wrap up, how long have you been perhaps investing in the global space? Or even generally,
In the global space investing, maybe this is my third year.
Third year?
Yeah.
I normally like to understand perhaps what are some of the lessons you have learned that you think any person entering into what you're doing should be able to basically, work with, something like that.
Okay, some of the lessons that I can share. Maybe the biggest thing is, invest in your investor education.
Okay.
Know what you are entering into.
Yes.
Yeah, because I think the first mistake that I made when I was investing, one of the mistakes that I've done when investing, I was watching a YouTube video. I think it was on a guy who was looking for a foreign investor who was coming to look at who had visited the Kenyan capital markets, the offices and the like. And then somewhere in between the video, he said that there are a lot of houses being built everywhere. Then he said that investing in a building or a cement company will be a good decision. Then the following day I was in the market buying bamboo. Right now I'm crying. Yeah, so I think I never did due diligence. I just glanced at their last annual report. I think I saw they had some profits. They had recovered. They had cut short on their losses.
Yeah.
But I never did a dig into their financial statements. I never really got to understand the cement industry.
Who are the players?
What percentage does Bamburi take? How it's a business, what their competitive advantages.
Yes.
So I never did that. So that's one of the big things I would like to say, get to know what you are getting yourself into.
Yeah.
Also, getting to have partners or people who can help you get started with investing. Like the biggest asset that people are looking to purchase in Kenya is land. And most of the losses in land isn't even in selling through losses or anything like that. It's through scams. People are selling you land that does not exist.
Yeah.
That's the easiest people lose money in Kenya. So just investing in your investor education. Yeah, that's very crucial. Also, the other day there was a guy who was complaining on Twitter that his company had invested, I think, 170 million in bonds. Then he wanted to liquidate his position.
Yes.
But now he had to sell in the secondary market and he sold at a loss. So he lost 17 million. He wasn't sure of how you can liquidate or the effects that could happen,
including tax and obviously brokerage fees, CDSE fees,
discounting the bond, because that's what actually happens. So he lost 17 million and he was like, I never knew this. Nobody told me about this. But now I've lost 17 million. Now he was seeking for help after losing that 17 million. So I think it's something Yeah, just that. Invest in your investor education.
Yeah.
Know the basics of investing, whether it's bonds, whatever you want to invest in or whatever you want to work with, whether it's offshore stocks, local stocks.
Yeah.
Just have a good understanding of it.
Yeah.
Do your research. Take your time. Earning money is hard. Making money is hard. But losing money is very easy.
Yeah.
Yeah. So just be very careful with how you allocate your finances. More so when you are investing huge amounts of money.
No worries. Finally, what are some of the mentors whom you are basically following and shaping perhaps your investment, procedure? Plus, also, what are some of the books you would recommend to those who are getting into the investment space, or the books which you are reading at the moment?
Okay, for me, I read a lot of Warren Buffett. So I think when I was just getting started, when I first read about Charlie Munger and Warren Buffett, I first read Charlie Munger's biography, biography or autobiography called Poor Charlie's Almanac.
Yeah.
I think that was one of the best books that I've ever read.
Okay.
Then I've also read Warren Buffett's biography, Snowball. Then after that, there are people like Howard Marks. He has a very good book called The Intelligent Investor. That's the book that I'm currently reading.
Love it.
Then there are a lot of podcasts or other bloggers or other authors that I really admire, like Morgan Housel.
Yeah.
Also Nick Majuli.
Yeah.
Also we have, for podcasts, there is The Rich, Wiser, Happier podcast by William Green. It's a very good podcast, though it's mainly for foreign markets.
Okay.
I also enjoy it. Yeah, so for book recommendations, I think the best personal finance book I've ever read, maybe it can be a discussion of maybe 2 books, but one I think the best and the most basic one for most people will be the one by Morgan Housel.
Nice one.
I'm getting some banter here.
Yeah.
I remember he mentioned that he went through our earlier episode of Warren Buffett versus Elon Musk.
Yeah.
So on books, I actually recommend a very good book called 0 to 1 by Peter Thiel. So this is a question to Warren Buffett or Elon Musk.
That's a tough one, but I'll say I think there are some attributes or things that I admire in both.
Yeah.
But okay, maybe I can go to the nitty-gritty in a few. But if I were to pick one, I'll pick Warren Buffett because he's a guy who seems to be more collected, more organized.
You literally pick the guy with less money.
Yeah. For now, he has less money. Yeah. For now, but I think how he has shaped his life, how he makes his decisions. He talks about mental models, his thinking, his reasoning.
Yeah.
And his just approach to life. It's something that I admire.
Something else, huh?
Also the principles that he lives with. Yeah.
His investors at Berkshire Hathaway have gotten their dues basically from him investing diligently. And obviously, after you leave here, another podcast that you'll be listening to will be Bullish Banter for macro insights, right?
Awesome. Yeah, definitely.
Yeah, I think that has been awesome. Unless you have any closing remarks as you go ahead with the day.
Okay, my closing remarks would just be to encourage people to be intentional with their finances, with their money, because I'm in the space. I work with people, so my daily interactions with people.
Yes.
I've seen people who are very reckless with their spending, with their finances.
Yeah.
Get stable and live a better life financially.
Yeah.
So I think everything in life, money comes into play in a lot of things in life.
Yeah.
So it's always a very good thing when you don't have that financial stress.
Yeah.
Financial stress never ends, but when you have better financial stress, because there's someone who is worrying where will get his rent. There's someone worried about where will I invest my next dollar? Is it in stocks or is it in bonds?
Yeah.
So for me, I'd rather have that stress of knowing where to allocate my assets than knowing how to meet my bills. So I'll advise people to also advocate for people to be intentional with their finances, to be intentional with their financial literacy, and to get to learn about investing. And to save, play the long-term game, and enjoy. Life is not all about saving and investing.
Yeah.
So you also have to live the life.
Yeah. I had the financial coach say you also need to budget for enjoying life.
Yeah, exactly. Yeah.
If you say it is 20,000, by the first weekend you went for Glen, 2 of them, and the money is done, the entire month you don't enjoy. You drink tea, and you go to church.
Sugarless tea.
Actually, there's a very interesting book that I think it is one of the most unconventional books about personal finance and investing, called Die with Zero. Written by a guy called Bill Perkins. So his approach to life is that when you are young, it makes more sense to borrow money. I'm just quoting how what the book says. It makes more sense to borrow money to get to enjoy some experiences, because now as you grow older, you probably or obviously make more money.
Yeah.
And you know, when you're retiring, you retire on the memories. You know, when you're young, you can jump and dive into a pool. But now when you're 60,
Definitely.
so if it takes borrowing money to have such an experience, then it makes financial sense. This is not, it makes financial sense.
So long as you can afford to pay, right?
If you can afford to pay.
Yeah.
So
Then-
as okay, I
you
think
can go
our
ahead.
time is up. So as we approach the end of the presentation, thank you guys. Thank you to our listeners. So we have talked about a lot of stocks. So I know you might wonder, where do I get the stocks? So at FX Pesa, we are a financial markets broker. We are licensed and regulated by the Capital Markets Authority of Kenya. So from our platform, which you can download from your Play Store, App Store, or from our website, you're able to actually buy some of these offshore stocks, as well as stocks from the Nairobi Securities Exchange, trade and invest. So it makes it easy for you to reach all these markets from the comfort of your phone, as well as your laptop. Thank you.
All right, guys, for myself, I think you have been noting down those books because we have mentioned at least 10 good books, and you can spread them throughout the year. Each month, one book, I'm sure, should change your life. Other than that, adios.
Bye, guys.